Let me be honest with you for a moment. You've done everything right. You work hard, you save what you can, and you keep your money in a safe, trusted bank account. But what if that very account, the one you check every month with quiet relief, is silently stealing your financial future? Not through fraud, not through hidden penalties, but through something far more dangerous, something most people over 40 never see coming. In the next few minutes, I'm going to show you exactly how your bank is designed to keep you broke, why millions of smart, responsible people fall for it, and the simple shift that can stop the bleeding immediately. Stay with me, because what I share after the halfway mark could change how you look at your savings forever. I've spent years studying personal finance, and if there's one mistake I see over and over again, especially among people in their 40s, 50s, and 60s, it's this blind trust we place in traditional savings accounts. We grow up hearing that a bank is the safest place for our money. Our parents told us, our grandparents believed it, and for a long time it was mostly true. So you opened an account, maybe decades ago, and you've been feeding it ever since. Every month, a portion of your paycheck lands there. You look at the balance, it seems stable, and you feel responsible. But here's the problem nobody talks about. That money is sitting in a coma while the world around it is getting more expensive every single day. You're not losing money in the way you think. The number on the screen doesn't drop. But what that number can actually buy is shrinking quietly, year after year, while the bank pays you pennies in return. Let me give you a real example that will make this painfully clear. Imagine a man named Raj. Raj is 45 years old, has a stable job, and keeps $50,000 in a standard savings account at a major bank. He's proud of that amount. It took him 15 years of discipline to build it. His bank pays him 0.01% interest, which is what most big banks still offer on basic savings accounts. Do the math on that. On $50,000, Raj earns about $5 in interest per year. $5. Meanwhile, inflation is quietly eating away at the purchasing power of his money. Even at a modest 3% inflation rate, Raj is losing roughly $1,500 in real value every single year. The bank doesn't send him a letter saying, "Sir, we've deducted $1,500 from your future." No, they send him a statement showing his balance is intact, maybe even with that $5 interest credit, and he feels safe. That feeling of safety is the most expensive emotion in modern banking. The mistake here is not that Raj is lazy or financially illiterate. He's neither. The mistake is that nobody ever told him there's a silent tax on stagnation. Most people believe that as long as their money isn't going down on paper, they're winning. But money is a tool, not a painting. It's not meant to hang on a wall and look pretty. It's meant to work. When your money sits in an account earning close to zero, the bank is using it, lending it out, investing it, and making healthy returns while giving you almost nothing in exchange. You're essentially providing them free capital and paying a hidden fee in the form of lost purchasing power. That $50,000 Raj saved so painfully will feel more like $35,000 in a decade, not because a thief took it, but because he never asked his money to do a single day of work. Now let's talk about another quiet killer. And this one hurts even the most conservative savers. The psychological trap of the emergency fund that never moves. You've heard the advice 100 times. Keep 6 months of expenses in an easily accessible account. That's solid advice. I'm not here to argue against safety. But what happens in reality? A woman named Maria, 52 years old, follows this rule perfectly. She has $40,000 sitting in a checking account linked to her debit card. She tells herself it's her emergency fund, her peace of mind. But here's what she doesn't realize. Every time she logs into her banking app and sees that large available balance, a tiny part of her brain loosens its grip on her daily spending. She's not reckless, but she buys the slightly more expensive groceries. She says yes to the weekend trip. She upgrades the hotel room just this once. The money never leaves the account in one big chunk, but over the course of a year, her balance slowly drifts lower than it should. She's not saving, she's hovering. And the bank loves that. They want your money to be so accessible that the line between saving and spending blurs into nothing. The practical solution here is so simple it almost sounds too easy. But it works every time. You need to create friction between your savings and your spending. Open a high-yield savings account. one that actually pays you something respectable, maybe 4 or 5%, and keep it at a separate institution. Yes, a completely different bank. When your savings live in a different app, a different login, a different screen, your brain treats that money differently. It becomes real savings again, not just a bigger checking balance. In Maria's case, moving her $40,000 to an account earning 4% would generate around $1,600 in interest per year. That's $1,600 she wasn't earning before. And even more importantly, that money is now out of sight and out of mind for daily spending. She can still access it in a true emergency, but the extra step, the 1 or 2 days for a transfer, is enough to stop the small leaks that drain accounts over time. Here's the harsh reality check most people aren't ready to hear. Your loyalty to your bank is costing you a fortune, and they're counting on your inertia. Banks know that once someone has an account open for 10 or 20 years, they almost never leave, even if that account pays nothing. They also know that most people are too busy, too tired, or too intimidated to switch. So they offer flashy checking accounts, nice apps, friendly customer service, and they hope you never check what your savings are actually earning. They profit from your comfort zone. And the truth is, if your money isn't earning at least enough to keep up with inflation, you're not preserving wealth. You're managing a slow loss. That's not an opinion, that's basic math. And it's math that millions of hardworking people choose to ignore because facing it means admitting that the safe choice they made 20 years ago isn't safe anymore. So what do you do right now, today, to fix this? Let me give you 3 action steps that take less than an hour combined. Step 1. Open your banking app and find the interest rate on your savings account. Don't guess. Don't assume it's fine. Look at the actual number. If it's below 3%, and I guarantee it will be for most of you, you're losing money in real terms. Step 2. Do a quick search for the best high-yield savings accounts available in your country. Look for ones that are insured, have no monthly fees, and no minimum balance requirements. There are plenty of them, and they're often from well-established institutions, not risky startups. Step 3. Move the bulk of your cash savings, not your monthly bill money, but the big chunk that's supposed to be your security, into that new account. Leave just enough in your checking to cover immediate needs, and maybe a small buffer. Then close the old savings account if the rate is insultingly low, or keep it open with a tiny balance if you must. But don't let your life savings sleep there anymore. If this hit a nerve for you, if you just opened your banking app and felt a knot in your stomach, you're not alone. I've been there, and so have millions of other smart people who simply never had someone explain it this way. Let me know in the comments how much your bank is currently paying you in interest. I'm genuinely curious, and I read as many as I can. If you have a friend or a family member, maybe a parent or a sibling over 45 who still has everything parked in one big bank, send them this video. Sometimes the most loving thing you can do is point out the slow leak they can't see. Hit the subscribe button if you want more honest money conversations like this one, because I promise you, the next video will be just as direct and even more useful. Thanks for being here, and take control of your money before someone else does. That feeling you have right now, the slight discomfort in your chest, the realization that you might have been losing money without even knowing it, that's actually a good thing. That discomfort is your financial instincts waking up after being asleep for too long. Most people never get to this point. They hear the hard truth, they feel the sting for a moment, and then they push it away. They tell themselves they'll look into it next month, or after the holidays, or when things settle down at work. And the bank loves that. The bank is counting on that exact response. They know that the longer you wait, the more likely you are to do nothing at all. So let me ask you a question that I want you to answer honestly for yourself, not for me. If you knew that leaving your money where it is right now would cost you an extra $10,000 over the next 10 years, would you still wait? Would you still put it off until next month? Because for many of you watching this, $10,000 is a conservative estimate. The real number might be much higher. Let me paint a picture of what the next chapter looks like when you finally stop letting your bank dictate your financial future. Imagine waking up 5 years from now, opening a different app, and seeing that your savings have grown, not just because you added more money, but because your money actually worked while you were sleeping. Imagine the quiet confidence of knowing that every dollar you saved is fighting back against inflation instead of surrendering to it. That's not a fantasy. That's what happens when you stop accepting a system that was never designed to build your wealth in the first place. Banks are not evil institutions. They serve a purpose. But their purpose is to make money from your money, not to make money for you. Once you truly understand that distinction, everything changes. You stop being a passive customer and you start being the CEO of your own financial life. There's another layer to this that nobody talks about, and it's especially relevant if you're over 50 or thinking about retirement. The erosion I described earlier, the slow death of purchasing power, becomes dramatically more painful as you get closer to the end of your working years. When you're 30, you have decades to recover from financial mistakes. When you're 55, the timeline is different. Every year of zero growth is a year you can't get back. And what makes this even more tragic is that the solution isn't complicated. It doesn't require a finance degree or a risky stock market gamble. It simply requires awareness and a willingness to move your money to a place that respects it. High-yield savings accounts, money market funds, short-term government bonds. These are not exotic instruments. They are basic, boring, sleep-well-at-night options that millions of people use. Yet the majority of savers still leave their cash in accounts paying nothing. Why? Because change feels risky, even when staying put is the riskiest move of all. Let me share one final story with you. A few years ago, I spoke with a woman named Susan who was 61 years old and planning to retire at 65. She had spent 30 years as a nurse, raised 2 kids on her own, and managed to save $120,000. She kept every penny in a single savings account at a major national bank. When I asked her what interest rate she was getting, she didn't know. She had never checked. She just assumed that because the bank was big and reputable, they were taking care of her. We looked it up together. 0.01%, $12 a year on $120,000. She sat in silence for a long moment, and then she started to cry. Not because the money was gone, but because she realized how many years she had lost. She moved her savings the very next week to an account paying 4.5%. That single decision, which took less than an hour, meant her money would now earn over $5,000 a year instead of $12. She couldn't get the lost years back, but she could stop the bleeding starting that day. Susan wrote to me a year later and said something I'll never forget. She said, "I finally feel like my money is on my team." You have the chance to feel that way too, starting today, starting right now. You don't need to become a stock market genius. You don't need to take wild risks. You just need to stop being loyal to institutions that are not loyal to you. The banking industry spends millions on marketing to make you feel secure, to make you feel like they're your partner. But a partner who pays you nothing while using your capital to enrich themselves is not a partner. It's a quiet arrangement where only one side wins. You deserve better than that. Your decades of hard work, your discipline, your careful budgeting, all of it deserves a financial home that multiplies your efforts, not one that dims them. So here is what I want you to do as we close this conversation. If you haven't taken action yet, pause this video right now. I mean it. The rest of this will still be here when you come back. Go to your banking app, find your interest rate, and look at it with fresh eyes. Then come back and finish watching. If you're still here and you already checked, you already know what needs to happen. Don't let another week slip by. The difference between knowing something and doing something is the difference between staying broke and building lasting wealth. This channel exists for exactly this reason. To have the honest conversations that the financial industry should be having with you but isn't. If this video helped you see something you were blind to before, hit the like button so more people can find it. Share it with someone you care about who still has their life savings parked in a low-yield account. And if you want to keep sharpening your financial mind in a world that profits from your confusion, subscribe and turn on notifications. I release new videos every week that cut through the noise and give you the truth in plain, simple language. Thank you for watching. Thank you for caring enough about your future to be here. And remember, your money should work as hard for you as you work to earn it. Don't let it sleep on the job. I'll see you in the next one.